This is Ralph Sass, and this is the lecture for Accounting 212, Chapter 5. I may have in the other chapters inadvertently called them 5. This is Chapter 5, and the key to this chapter, or what this chapter talks about, is calculating break-even points. In order to calculate a break-even point, it is best if we put things in what we call a contribution format income statement. Okay, so those are going to be the best ways to do that. And what that means is that we're going to put all of our variable expenses at the top. We're going to look for our contribution margin, and the term contribution means that's the amount of money that can contribute to covering fixed expenses. And then we're going to subtract our fixed expenses to get our net operating income. So when we want to do a break-even analysis, it is best to put our income statement into this type of format. Okay. So that contribution margin, I already mentioned that, is first used to cover fixed expenses, and then anything left above that, over and above that, is available for net income. Notice a lot of times it's very helpful to take a look at things on a per unit basis. Okay, a lot of times it is very beneficial to take a look at things on a per unit basis. In this case, they're selling the bikes for $500 each. The variable expenses are $300, so the contribution margin is $200. And the reason is that means that once they have covered their fixed expenses, every additional unit generates $200 in pure profit. Okay, this has huge implications for how you structure a business, or how you structure your business between fixed cost and variable cost. It's possible to move costs from fixed cost to variable cost and back and forth, depending upon how you pay people or what have you. It's easy to take a fixed cost, a $200 a week salary, and turn it into an hourly position of $8 an hour, and all of a sudden what I've done is turned a fixed expense into a variable expense. So it's very possible to do that. So that's what that $200 there, it tells me, and a lot of times it's beneficial to do this also on a per unit basis. Okay. Notice each month they have to generate at least $80,000 in income in contribution margin just to break even. Okay, just to break even. Okay, and so notice that that 400 units a month is the break-even point, because at that point, okay, I'm earning no income, and my contribution margin is just enough to cover my fixed expenses. Quick note on a little bit of math here. If I take that 200 per bike, multiply it times the 400 bikes that I'm selling, that gives me that 80,000 that I need to meet my fixed expenses. Notice what happens if they sell 401 bikes. If they sell 401 bikes, okay, net operating income increases by $200. Now, a quick note here to show you how volatile, if you will, company's net income is. Suppose they sold 402 bikes. If they sold 402 bikes, their net income would go up to $400. Okay? Notice that is a 100% increase in net income. Okay? But the number of bikes they sold went from only 401 to 402. So their sales went up by one bike on, let's say, 400. Okay? So that their sales went up by 1/4, if my math's right, of 1%, 1/4%, and net income went up by 100%. Just goes to show you how highly leveraged companies are to sales, depending upon how they've structured their fixed and variable costs. Notice that because of this, you don't need to calculate an entire income statement to estimate profits. We know if they sell 430 bikes, their net income is going to be $6,000. How did we get that? Well, quite simply, they're selling 30 bikes more than their break-even point, because their break-even point in bikes is 400, so they're selling 30 extra bikes. Each bike's going to generate $200 in contribution margin. All we have to do is multiply those, and we'll get $6,000. In equation form, we take sales minus variable expenses minus fixed expenses will give us our break even, and I'm not a big fan of the equation form, but we'll go ahead and show you how that's going to do. Notice if sales are 401 units, okay, at $5,000, we take the $200,000 of sales minus the $120,300 of variable expenses minus our fixed expenses, and it gives us a profit of $200. Now we're going to get a little fancy with the math here. Once again, how do we figure out sales? We take the quantity sold times the price per unit. How do we figure out the variable expenses? The quantity sold times the variable expenses. Okay, so we get a formula that looks like that, and we can simplify it a little. Okay, well, they didn't simplify it, so let me go ahead and simplify it. I'm going to, if we want to use this is not my preferred method, but I'll show you my preferred method in a couple of minutes. Since I've got Q in both spots, I can take the price minus the variable expenses, multiply it times Q minus the fixed expenses. Okay, just a little algebra there to make life a little simpler, if you will. But that's how we can go ahead and modify that. Okay. So taking a look at 401 bikes, there's my profit, and now my profit is up to $200. Notice I can get there, in my opinion, a little easier if I use my quick little formula and say 500 minus 300 times 401 minus 80 grand. But that's just me playing with algebra. Notice now they're going to go ahead and show you what I just showed you and take the unit contribution margin, P minus V times Q minus fixed expenses. So I've already shown you that. Okay, and we can use that formula there, and I already showed you that, and the profit comes out at $200. Now, a lot of times it may be helpful, especially when you're explaining this to others, to put it in some graphical form. And notice what they've done here is they've figured out the break-even points, or net income, if you will, for various amounts that are sold. If they only sell 200 bikes, okay, if they only sell 200 bikes, they have a loss of 40 grand. If they sell 400 bikes, they break even. If they sell 600 bikes, they make 40 grand. And what they can then do is turn that into a nice little graph. For those of you that have had me in economics or have had some microeconomics, there's my fixed expenses, fixed at 80 grand. Okay, that are my total expenses, which is going to be fixed plus my variable. And that green line there is going to be my total revenue. Notice it starts off at 0, proceeds up, and it proceeds up at a bigger slope. If it doesn't go up at a higher slope, you'll never break even. Okay, and now notice I can see graphically where my break-even point is by just dropping a line down there, and where my total revenue and total costs are equal is where my break-even point is. So that's my break-even point, and my total dollars that I have to sell, $200,000. For people that are unfamiliar with break-even analysis, what have you, sometimes seeing it in a graphical format like this helps them make sense of it. Okay, any area to the right is where I make profit. Any area to the left is where I will lose money. And sometimes they even make it a little simpler by showing at various units how much money they're going to lose. And just draw a graph like that, And in that particular case, there's their 400 for their break even. And personally, I'm not a big fan of that graph. I'd much rather have the prior one, but in some cases, people may use a graph that looks like that. The other way to think about things is not only in terms of per unit, but to think in terms of a contribution margin ratio. Okay? And what we have here is sales price is 100%. The variable expenses are 60%. Contribution margin is 40%. How did they get that contribution margin? They took 100 grand and divided by 250. Note they could have also taken the $200 and divided it by the $500, and it would have gotten you to that 40% as well. Notice that 60% is the complement of that 40%. Those two numbers have to equal 100%. So once you figured out one of those numbers, you can figure out the other one. That 300 there and that 60% makes perfect sense, because if I take 300 divided by 500, that will give me that 60% as well. Okay, and there's the calculation based upon a per unit. Now notice what we can start to do. If the sales increase by 50 grand, okay, if sales increase by 50 grand and contribution margin will increase by 20, how'd they get that? 50,000 times 0.4, okay. So what that tells me is that their net income, okay, is also going to go up as long as they've hit their break even, or their loss will go down. So a $50,000 increase in sales leads to a $20,000 increase in contribution margin, which in this case leads them to go from breaking even to a profit of 20 grand. Now notice we can do a number of different things with this, and this is just one of those multiple choice questions. Average selling price is $1.49. Average variable expenses is 36 cents. Okay. Average fixed expense is $1,300. Question asks you, what's the contribution margin? Okay. So in order to figure out the contribution margin ratio, okay, I have to take the selling price of $1.49, divide it by my contribution margin. My contribution margin is $1.49 minus 36 cents, or $1.13. So my contribution margin is 0.758. What that tells me is that for every cup of coffee that this espresso stand sells, 75% of it is going to cover fixed expenses and then profit. That's what that number is telling me. Okay, that's probably a pretty good number, to be quite honest. Notice what happens if it increases its sales volume to 500 bikes. Okay, what would their net income be? Net income would go up to, in this case, 20 grand. Okay, from 400 to 500 bikes. 400 was break even, 500 is their profit. We can talk in terms of a variable expense ratio, and it's the ratio, and businesses often calculate this as well. It's the ratio of variable expenses to sales. It can be computed by dividing total variable expenses by total sales. I prefer to think of it just as the complement. Okay. But either number is important, whether it's the 60% or the 40%. But once you've calculated the one number, the other number just falls out because it's the complement. They have to equal 100%. Okay? Now what this allows us to do is it allows us to start to get very fancy. Notice what we have here. Okay? So what's going to be the impact in managers, salespeople will often come to you with this. Hey, I can increase sales from 500 bikes to 540 bikes by increasing our advertising budget by 10 grand. If we run that ad on TV or we run that ad on Facebook, it's going to cost us 10 grand, but we're going to be able to sell 40 more bikes. Question is it worth it? Okay? And you go, man, we're going to sell 40 more bikes. Yeah, let's go ahead and do it. But then you look at the numbers. Okay? Notice what's going to happen. Yes, we're going to sell 40 more bikes in this case. Okay? We're going to sell 40 more bikes, but notice what happens to our net income. Our net income is going to go from 20 grand down to 18. Now, I could predict this early on. Okay? I am going to sell 40 more bikes. Each bike is going to generate for me $200 in contribution margin. Those additional sales are only going to allow me to increase my contribution margin by 8 grand. I can't pay 10 grand for that advertising if it's only going to increase my contribution margin by 8 grand. So I can get to this very simply by knowing what my per unit contribution margin is. Note, since the advertising is costing me 10 grand and I'm only generating 8 grand in additional contribution margin, it makes total sense that my net income would go down by 2 grand. Okay, and this is my incremental analysis explanation, which I just explained. This is the quick down and dirty way to do it without recreating an entire income statement, what have you, from scratch. Another thing, okay, another way to look at this. What is the profit impact, okay, once again, on this company if they use higher quality raw materials, increasing the variable cost by $10, but sales now go up from $500 to $580? Well, if I increase my variable cost by $200, notice what's going to happen. They were $300, They were $300. Now they're going to go up to $310, so my total variable costs are going to go up to $179,800, which leads to my contribution margin down to $10,200, or up to, I should say. My fixed costs are still 80 grand. What happens to my net income? My net income goes up to 30,200. So, should I go ahead and do that? And the answer is yes. I've increased sales by 40 grand, but my net income's gone up by 10,200. Now, once again, could I do this in a shortcut method? And the answer is yes. Okay. If my variable costs are 310, my contribution margin per unit is 190. Okay. So I take 580 times 190, subtract my fixed cost to 80 grand, and once again, I'll find out that net income is going to go up to 30,200. Now, one last item before I end this recording and start on the second part. Let's do one more. What's the impact if they cut the selling price by 20 bucks a unit? Okay, keep in mind, my variable costs aren't going to change, but my contribution margin is. I increase my advertising budget by 15 grand, and sales go from 500 to 650. All of a sudden, by setting up your income statement this way, I can do a lot of what-if scenarios. Okay, so notice what happens. Okay, I'm selling 650 units at 480 bucks a piece, so my total revenue goes up to 312,000. My variable expenses are 195. They didn't change. Okay, my fixed expenses increased by 15 grand. Net operating income went from 20 to 22 grand. The question is this a worthwhile decision? At this point, it kind of depends on how you view, that. Does it increase your profit? Yes. Does it increase it very much? In my opinion, the answer is no. But that would be a decision for those managers to make. That concludes the first part of the lecture for Chapter 5. As always, if you have any questions, please let me know.